Hi, it's March 2nd, 2016, Wednesday. It's 11 o'clock here in London, or 6 a.m. Eastern Standard Time in New York, or the US. Um, yeah, I'd like to talk today about the stock markets. And in my view, looking at the technicals, um, it looks quite worrying, in my opinion. I've done a little bit of analysis on the monthly chart of the Dow Jones Industrial Average, and to me, I don't want to sound alarmist, and I know most people prefer things to work out, more moderately, but in looking at the picture that you will see soon, it looks quite scary. What could happen in the next few months, even 6 months, even less than 6 months, in my opinion. So here we go then. So I've gone back, as you can see on the chart coming up here. I've gone back on a monthly Dow Jones Industrial Average monthly chart. It's called Wall Street on this chart. I've taken it off IG Index. And as you can see, in January 2000, the high in the Dow Jones Industrial Average was 11,750. And these are not closing highs. These are just the highs. And that was the top of the the famous dot-com bubble, NASDAQ bubble. The Dow made an all-time high there, and then it took 34 months for the Dow to basically correct, bear market correction of 34 months. And as you can see in the chart, we bottomed in October 2002, and the low was 7,197. Again, that's not a closing low, that's just the low. So that from the high in 2000, January 2000, to the low in October 2000, there was a 38.7% correction, or drop in the Dow Jones Industrial Average. And that was at the time when Alan Greenspan was still Fed chairman, and rates at that time were brought down to 1%, which might sound really normal nowadays, but back then, believe me, because I'd been working in the markets then for over 10 years, it was quite revolutionary to have Fed funds rate at 1%. And that, of course, led to the bull market that started, from the low in October 2002 to the high in October 2007. That led all, to that real estate subprime boom. And despite that market going up, the Fed was actually, reining in the easy money, and interest rates actually topped around 6 3/4. So that was still normal monetary policy, but the fact that the Fed had dropped rates to 1 made this next leg even higher than the previous leg. So we topped, as you can see, October 2007. The high was 13,895, and then we had an 18-month bear market or correction, and the low was in March 2009 at 6,470. And that, of course, was not a closing low, but that was the monthly low in March 2009. So that took 18 months, and the drop was roughly around 53.4%. So, bigger drop than the previous drop. And also, the correction was almost half the time, a little more than half the time, 18 months compared to 34 months. And now we come to the last, and I think this is not the current, but the last leg up or bull market that started when the low in March 2009 took place. And in terms of monetary policy, the Fed cut rates basically to zero. They've bought, almost $4 trillion of mortgage-backed securities in U.S. Treasuries, i.e. QE, and they bought that through creating money out of thin air. So it's been totally overwhelmed, the Greenspan policy of going down to 1%. Mr. Bernanke and Miss Yellen have totally overwhelmed, monetary history with a totally irresponsible, in my opinion, monetary policy. And as you can see, the leg up has been even bigger. So we've topped now in May 2015 at 18,365. And so, I've made some projections here. And before I go on to my projections, I would point out that there was a low in August last year, and we haven't broken that low yet in the Dow, as you can see that chart. But we've been at it for about, we haven't been able to make a new high. And if you look, since 2009 when we've had corrections, it's taken about 4 to 5 months from the lows of those corrections to make a new high. And we're nowhere close to getting back to that new high. So, yeah, looking at projections, then you would say, this chart looks like, the monetary policy is making, is goosing up the market every time even more than previously. And but the corrections are getting shorter and sharper. So with that in mind, look out below. And I've taken two, projections. One would be an 18-month correction, which is similar to the previous correction, 07 to 09. And that would take us to an October 2016 low. And I took a 53.4% drop as well to equal the, the 07-09 drop, and that took us to 8,559 in the Dow. And that might sound really crazy, but if you told someone, in October 07, when the Dow was almost at, got around 14,000, if you told someone that by March 2009 it would be down at 6,000, they'd think you're crazy. So in my opinion, this is quite possible. And then I've taken a second projection to make it, quicker, because as you can see, in this megaphone, the moves have been getting sharper, the correction is sharper. So I've taken, let's say, 12-month correction, which would take us to around May, this year. So we're not too far away if this scenario were to, occur. And I've taken a little more, of a loss. I've gone with 61.8% drop, which is a Fibonacci number, but it could be more. If you extrapolate the increase from, the correction in 2000 to 2002 to the correction 07-09, it's actually more, but I'm going with 61.8%. That would take us, down to 7,015 in the Dow. But as you saw earlier with that chart that I showed, the bottom of the megaphone, the trend line below, is around 6,000. So yeah, this, I might be wrong. And, in the last few years, people who've been calling for big corrections have been proven wrong. But, I just wanted to warn people that that's a possibility, that we could see a very sharp drop in the Dow and all stock markets for that matter in the very near future. Let's see, apart from that this morning, yeah, the market's fairly steady. Well, the Dow is down about 37 points. We had a big move yesterday up. The gold price is down slightly at 12,031. Silver pretty much unchanged at 1480. The currencies are pretty much unchanged as well. But my focus, of course, was the Dow, and a warning to people. I'm not telling people to do anything. I'm just giving you my point of view. Have a good day and rest of the week. Take care.